if we can throw it over to you in Canada.
Sure. Thank you, Ned. So I am the lead portfolio manager for a team in Canada. We manage high net worth clients. So essentially, it's we're doing portfolio management, discretionary portfolio management, and wealth management as well. We're affiliated with a large bank, RBC, which is pretty much one of the biggest banks in Canada. We do have US clients. We have capabilities to portfolio manage in the US, slightly different regulation, as you would know, Brian, but we are licensed there as well. And yeah, so looking forward to share and happy to be on the panel.
And little known fact that we discovered just before the panel, at 22 years and 7 months, starting from an intern, Robert is the longest serving intern now employee, I would imagine, at the firm.
That's correct. I still think of myself as an intern sometimes. So,
because we've all heard of hyper-personalization, but they used a terminology that I think is relevant: customized simplicity. And I really like that idea, that it's got to be customized, but it's got to be simple, because if it's not, you're serving your customer something that isn't quite right. And I think that is so important. And Robert, clearly, being part of RBC, Canada's seen a lot of these robo-advisors are growing there. How have you seen your customers change? Are you guys getting it just right? Is the porridge just the right flavor for your customers at the moment?
Yeah, so there's been a lot of changes. I mean, since I started 20 some odd years ago, we've gone from more transactional style business to a fee for service business, which is essentially what the portfolio manager does. But that's not what's changed. What's changed is the expectations. Before I talk about that though, and what we're seeing as kind of like the most important things for these clients, I just want to tell you like what our team is focused on, why we do what we do, and that's important. We're trying to make those clients that deal with us, we're trying to make them into, more aware of, let's call it better investors, okay, generally. But it's a very general statement, but it is what it is. And anybody who's associated with us, or anybody who knows us, or listens to us, or watches our content, and learns from us, we're trying to also educate those people. So why we do what we do is to make everybody better at investing, essentially. Now, how do you do that? Well, that's based on what the client wants most. So client wants something that's extremely optimized. So that's where you can use the typical tools. AI is helping us with trade execution now at RBC. We've invested a lot of money in that, but also we use some third-party tools as well. And you want to build portfolios that are extremely, efficient. So that's a given. But I think you can get that almost anywhere, right? So the key then is behavior, right? So the high net worth client has access to tools. They have access to, these are not emerging investors, right? They've been investing for some while, but now we need to elevate them to another level where the communication is extremely clear. I think you mentioned efficient. There was a word you just used. I couldn't remember, for the how much you show and kind of like,
customized simplicity.
Customized simplicity. That's extremely important. So what we see on the back end is obvious to us. What's not obvious is what the client sees, right? What they interpret. And remember, investor behavior is extremely important. So the key is to use, I'm gonna say, to use financial tools or to use technology to promote good behavior, is to promote the feeling that we don't need to use our emotions to make better decisions. That's what we're really trying to do. And I'll talk about some tools, I guess, later, and what we've developed to help our clients do.
Absolutely, that makes sense. And maybe as we move on to the second question, you mentioned that Belgium and Canada are efficient markets. I would love to hear from Brian and Robert if they think that's the case. And maybe Robert, are markets really efficient? Are people able to save and invest in the right way? I think, America, one of the most, where people invest all the time, there's still inefficiencies. And so, what are the strategies you use for this digital? Maybe digital gap isn't always the right word, but what are the strategies? How do you think about it? How do you move it forward? We all know the customers want more, but how do you make it more efficient for them, Robert?
Yeah, so I think I'll talk about how we plan more efficiently, because I think the investing part in North America, whether you're in Canada or in the US, we have access to amazing tools, and whether you're building just a simple, portfolio driven by ETFs, or you're actually it's a quasi, half manager ETF, half individual holdings. All that's driven by the capability of the firm and the capability of the portfolio manager. Obviously, our portfolio management team is fully capable. So we do hedging, we do asset allocation, we do alts as well. Obviously not as active on the altcoin space yet, and that's normal because of regulation here. But also it's not only our firm, by the way, it's all North American firms that are extremely cautious, but recognizing the what's happening there. So I'd rather talk about the planning side, right? And so how do you bridge that gap? So everybody knows, you have online tools, right? Online access is essentially what's driving global business, and that's how we can have, clients everywhere. As my co-panelist just said, he has clients all over the world, which is awesome. And look at this panel; it's amazing. So the difference is what the client sees. So when it comes to digital enabling, I feel like we have it. What we do not have is digital visualization or coaching. So you do have a little bit of that. Some of the fintechs are starting to, where you can plot, okay, we're here, and if we do certain actions, we can be here, and the visual tools. But those are all driven by the inputs of the investor. When you have a portfolio manager or a wealth management team coaching and enabling and educating, we can help you understand the benefits of that visualization. So what we've done as a team, I'll talk about it. We've created a tool, and it's not only been over the last year and a half because of COVID, it's been something that we've had for about 6-7 years now. We've created an online tool for each one of our clients that's similar, and it's all based on the same fundamentals, but it's all optimized again, Ned, what you need to just for them. It's customized for them, right? And so that's our way of keeping them abreast, keeping them engaged to be a better investor, keeping them unemotional, making the right decisions. And it helps us as a team understand our clients better, because that's our visual tool. So it's a front end and back end tool, not only for us, because that's what most of the firms do. They have tools for the teams, the advisors. They don't have tools for the clients. This is a two-way tool, and so that's what we've created. And yes, there's a bit of maintenance to manage these, but luckily we have the capabilities and the team to do it. We hire very smart people. We'd rather hire people who are good at have skill sets than have finance degrees. So that's how we're managing let's call it the digital aspect of how we're making our clients be better at investing.
It's fascinating. So I think we've all been benefits of what is, I don't know, a 10-year bull run now. And I have a feeling that robo-advisory might not have existed if we had a 10-year bear market, because no matter how good digital is, if you digitally lost 30% or 10% a year for the last 10 years, well, you don't have much money left, but everyone's cheering on, oh wow, hasn't technology been amazing? But Robert, we've been in an environment that we've been allowed, like as Brian said, yes, by Amazon's gone up. Okay, I don't want to make a profit, I'll trim my profit. I would love to hear how ESG people would be if they were losing money, and how much is it going to come down. Robert, how in Canada, how do you see that? Same kind of view or different?
Yeah, so Canada is especially unique because we're, similar to Australia and some other areas, we're heavily. It's a country that has a lot of resources, a lot of companies in oil and gas. It is a big deal, and there's parts of our country that they want to support the oil and gas industry, and it's very important to them. And our definition, I think generally Canadians' definition of ESG is different from other parts of the world. But Canadians are very environmentally conscious people. We live in a beautiful country, and ESG, by the way, let's not forget, it's environmental, social governance, right? So it's a lot more than environmental. It's how companies run themselves. It's the boards. It's the way they select their employees. Are they an equal opportunity employer? All those things. Do they do good for society? Do they give back? So you can make a point that Amazon's evil, and then you could also make a point that Amazon's the best company in the world. So there's different ways to weigh ESG. But just going back to Yeah, so I think we were talking more about how you can get notified. Let's go back to why don't we talk about the notifications, or being able, like AI can tell me on Netflix that I should be watching Bridgerton, for example,
Yep.
based on my previous it's a silly example because it wouldn't be telling me that, but it's telling my daughter to watch that.
It's okay.
Yeah, I know we all did. So and then it'll say, so based on what you watched, this is what you'd like next. You're absolutely right, Ned. What's the deal? Why are we so behind the eight ball? And my feeling is that in finance, it's because the information is much more, let's call it private. And I guess in Canada, it's very regulated. And is it because, we're not allowing AI to give us those recommendations? And that has to be the case. So I think that's going to change very soon. And I'm hoping it does, because we're looking, I can only do so much personal coaching. I would like also for the AI to help me execute those emotional responses, or the right response for our clients, right? Remind them of the things that are important. Instead of me sending the reminder, I would like the AI to send that reminder. So I think that's where we need to go. And I agree with you, Ned. We're behind. And if anybody thinks, a fintech is ahead for that, it's absolutely not ahead. So I'm excited to see where, how things develop in the coming years.
I wonder if it's, Robert, to your point, I wonder if it's partly, you say, why haven't we done it? Wealth's been a high margin business for too long. People have made a lot of money with high fees for a long time, right? Because it is a complex industry, right? So there hasn't been the push to change, right? So maybe I think now we're starting to see, and again, I think COVID created this, there's no choice now. Like I think even 2 years ago, people used to say, oh, robos might not work, or wealth management might not go digital. I don't think anybody's talking that game, but I also agree we don't want it to go digital and just digitize our existing processes that someone still has to press a button.
Correct. It could be dangerous to you need to have, it needs to be we have to be the guide, or we still have a guiding effect. And yes, it's high margin, because it's anything that requires anything that can cause a mistake from happening is worth paying for. Like you can say, oh, I paid less fees, but I can also show you, that those less fees, if you get worse returns and worse responses to market events, that can cost millions of dollars down the road for any client. So there is a fine line between paying for what you need and what you're getting. But just to go back to the high margins, I don't think that's the case. I think it's because the wealth managers or the banks are fearful that if they start pushing too much information to the client through AI, that might cause clients to do things that possibly could disrupt planning, or so there's, we also have to be, we want to limit how much the client is involved, because a client reads a headline, wants to act on the headline. That's not necessarily the case. The reason why Warren Buffett is one of the richest men in the world is because it doesn't act on headlines, right? So these are the kind of things we need to promote. So it's a fine line. I think the planning side needs to have more AI, and the investment side, I would say that we are too short term generally, and it's become worse, by the way. And Shivan talked about it. The things change a lot. Yeah, but the problem is the young investor thinks that they need to trade more. You don't need to trade more. You need to accumulate. And some are they're holding, right? And we're holding this long term. But we see the behavior as that's not actually the case. We see a lot of trading. We see the volatility is caused by people buying and selling, and being home, Ned, being home. Because you couldn't go out for the last 12 months, and in some places you still can't go out. They have time to do this trading. So I don't want to get too much off topic, but I thought that could be disastrous also for us.
We're coming towards the end of the panel. Maybe give a minute or two to give maybe just a summary, like where are we in the whole changing of digital wealth? What is the summary? What's your kind of thoughts of where we are now and where we're going in the next 5 to 10 years?
So I think we're at a good place right now. And like I said, it's all about behavior, right? So I think we're getting a lot of new investors. We talk about millennials a lot. That's a good thing. When I started, it was markets were at all-time highs, was .com, and we were trading in the classrooms, but we were calling up and we were trying to, there was dial-up back then, but we were able to trade. I mean, we paid for trades back then, but it was still marginal, very, very low. Now they're free in many cases. But all that to say was that stayed with us. Okay, so my cohort is, everybody in my cohort, my age group is now investing, and they're investing wisely. Not always wisely, but they have experience, and they were risk averse for a while. And I would imagine that's going to happen here as well if people make suboptimal decisions. So what do I see happening is I see that cohort becoming very engaged, which is good because there's going to be huge pass through of wealth over the next 20 years. And by the way, the millennials are one of the biggest cohorts since the baby boomers. So that's another good thing. So this bull market will be around for a while. But you're right, Ned. When we have a bear market, I don't know how well robo will do. But to be quite honest, I don't know how well traditional will do either. So I think it's a fair match. It's a fair game. I do think that eventually, we are used to these devices sending us notifications. We are used to having information readily available. We are used to having decisions helped by AI. This has to be the standard in financial services. If it's not the standard, that those providers will be eliminated. So this is where we're going over time. I think people generally are emotional. I think if they can, they can be coached and the tools they're using remove that emotion, they're going to be much better investors. And remember what investing is all about. It's all about time in the market, compound interest and time in the market, and making optimal decisions and planning. And by the way, like anything in life, fail to plan, plan to fail. So if you can do those 2-3 things correctly, it's simple things. It's not, well, what's the best, crypto going to be? What is the best stock going to be next year? It doesn't matter. In the end, you have to have a process. You have to be investing. That's the key. And if we can enable clients with technology to do all that, then we've won. And that's what our goal is, and that's what we're trying to achieve. So I think that's my takeaway. And I see it's going to get only better from here.
It's a great summary. I'm with you. I think there's just going to be massive AUM kind of growth because, hey, look, when I was 21, I didn't have any money. I'm a bit older at 54. I didn't have dial-up. I didn't know how to call a broker. I just didn't have any way to invest my money.